All right. Good evening, everybody. We will go ahead and start tonight's webinar. My name is Thomas Wood. I'm going to be the host of the webinar today. I'm also the host of the Value Charts Futures Live Trading Room and the head of technical analysis and live trading for Microquant. Today we're going to be talking about value range trading on intraday divergences in crude oil. So essentially we'll be talking about scalping, a strategy for scalping crude oil from anywhere from 5 to 50 ticks at a time. Very short term trades, they typically last between 5 and 20 minutes maybe. So not very long. Again, you're only taking small pieces at a time out of the market and trying to risk as small of an amount as possible. If you have any questions at any time, feel free to submit them via the GoToWebinar side menu located on the right-hand side of your screen by the Questions tab. And at the end, I'll go back and I'll try to answer all the questions. Make sure everyone understands everything pretty clearly. What we'll do is we'll go through the PowerPoint. I'll explain basically what the strategy is, and then we will look at a couple examples, and we'll pull up TradeStation and go back and look at examples that have occurred in the past, some that have happened today on 1, 2, and 5 minute charts, and some that have happened in the past as well, all in crude oil. But this strategy is very viable for any market. You can trade intraday divergences on multiple markets. So if you want to learn more about it, if you get interested in the divergences from today's workshop, you want to know a little bit more information about how to identify them, when to trade them, when to get out, when to get in, how to set your stops, all that. We're going to be covering all of that in the Divergence workshop coming up here in a couple weeks in April. Regarding the Divergence workshop, be aware the price is increasing from the early bird special on Thursday on the 28th. So it's going to be going up in price. Right now it's at half price due to the early bird special, but it will be increasing on the 28th. Before we begin, very quick risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown, and past performance is not necessarily indicative of future results. Along the same lines, we're required to show you CFTC Rule 4.41, just a hypothetical disclaimer. That's saying for tonight's webinar, all the examples are hypothetical, even if they were participated in by us here at Microquant, which not all of them were. Some of them were, though. They are for hypothetical purposes only, so they're for education, and we're not guaranteeing you any results. So first off, let's get started with what is the goal of value range trading and scalping these intraday divergences in crude oil. First off, scalping is your goal. Keep in mind, when you're value range trading, your profit target is reached very soon, a lot of times. Now, I'll show you ways that you can adjust this so that your profit target takes a little bit longer to get to. However, we're doing it for scalping, so you're not trying to catch these huge moves. You're trying to scalp it in and out very quickly with as small amount of risk as possible. And along those lines, goal number 2, taking small pieces out of the market between the value ranges. So we're trying to get in and get out between undervalued and overvalued, or vice versa, from overvalued to undervalued. Also, we're trying to risk as small of an amount as possible with these trades. So typically I'm risking, if I'm scalping crude oil, I'm trying to risk between 5 to 10 ticks at the most with the trade. And when you're entering on these short time frames and you're doing it properly, entering on the right side of value, you can really have very little risk. You can almost get down to the tick when the market's going to turn in your direction. Now, how do you trade this strategy? How do you trade a divergence, and what is a divergence? And then How exactly do you trade a value range trade? What is a value range trade? Well, first thing you're going to need to do when you're trading the strategy is identify the divergence. What a divergence is when a market or the price continues to go one way while the indicator, in tonight's case we're going to be using NQ momentum to identify the divergences, while the indicator goes the opposite direction. Okay? Typically, when a market's moving higher, your indicator and your price are going to be correlated, meaning they're going to be moving together. They'll both be going higher as the price goes higher, or they'll both be going lower as the price goes lower. A divergence occurs when there's no longer a correlation between the two, meaning they become negatively correlated, where one's continuing to go higher and the other one is going lower instead. It can also be the opposite direction. Prices are going lower while the indicator is going higher. So divergence is when the indicator and the price are no longer moving with each other. We'll also talk about tonight adjusting your value bars and value charts according to the time and the volatility. With crude oil, you'll have a much tighter trending market during the after hours trading. For example, right now, what's happening in the markets? There's going to be less volume, so it'll be a little bit more choppy when we go into the grinder. Now, when it's in those periods, there's also a lot less movement, whereas intraday, during the hours between about 7 a.m. and 2 or 3 p.m., there's much larger price moves. So you're using a longer analysis period during the intraday periods, during the intraday times between the prime trading hours, and you're using a shorter analysis period during the grinder because you're trying to identify much smaller price moves during the grinder. You can still trade during the off hours. A lot of the signals aren't as visible, and you're not going to be making as much money on the price swings because the market just doesn't swing 100 or 10 ticks, 20 ticks at a time where it can do that during a normal trading hours. The last thing that you need to be doing when you're trading the strategy is you're only entering at the appropriate value levels and you're exiting at the opposing value level. If you can't get in at the right value level, then it's not worth trading it because you have to be very picky with your entry. When you're scalping like this, 1 or 2 ticks can be half your profit because, again, you're just scalping. You're taking 5 to 10 to 20 ticks out at a time, where if you're getting in late and trying to chase it, where you would typically have a break, you're actually going to be at even in the trade. So instead of being up $30 or 3 ticks per contract, you're going to be at even. So a lot of times I'll use limit orders when I personally trade this, and I'll put my limit at the previous high or low, or just beyond it, or just below it. So it depends on how you personally want to trade it. If I'm trading a non-liquid market, such as RBOB or heating oil, for example, or platinum, then I will definitely use a limit order, because with liquid markets like crude oil, your spread is only going to be a tick or two. So sometimes you can get in during prime trading hours without really risking too much with a market order. Whereas if you get in RBOB in off hours or heating oil or platinum, you're going to automatically be in the hole by $40 or $50 a contract due to the spread. So again, we're going to be identifying divergences. Then we're going to be adjusting our value bars or value charts according to the time of the day and the market conditions, whether it's choppy market or less choppy market, and also depending on how soon we want to be getting in and out of these trades. So if we were looking for longer term trades, we'll use a longer analysis period. If we're looking for shorter term trades, we'll use a shorter analysis period. And then we'll only be entering at the appropriate value levels and exiting at the opposing value level. Remember, when you're value range trading, if you're going long, you're in it undervalued and out at overvalued. If you're going short, you're in it overvalued and you're out at undervalued. So let's take a look at a few different chart examples very quickly on the PowerPoint, where I'll show you what the divergence is, show you some examples of divergences on a couple different time frames, and then show you examples of divergences with a longer analysis period on a couple time frames, and then we'll pull up TradeStation, look at divergences that have occurred today and occurred in the past couple of days on 1, 2, and 5 minute charts, because again, we're just doing intraday scalps basically. Now, that being said, it can also be used for longer term divergences. You can trade daily, weekly, hourly, 30-minute, 15-minute divergences all day long. You just got to keep in mind your risk is more when you're trading a longer term divergence because your technical analysis is the same, so your stop placement is going the same. And if you're looking at a 30-minute chart, there's a lot more movement that can occur in 30 minutes than there is in 1 minute. And again, if you want to really get a lot more information on how that works, I would encourage you to come to the Divergence workshop. So crude on a 2-minute chart. Here's an example. We're using a 5-bar analysis period with value bars here. And this is again a 2-minute chart. So we have bearish and bullish divergences. Bearish divergence occurs, remember, when your price and your momentum or your indicator are no longer correlated. So here, upper yellow bar segment is saying moderately overvalued. Okay, that's what value bars are doing. Lower yellow bar segment is moderately undervalued. Lower red bar segment, significantly undervalued. Upper red bar segment, significantly overvalued. Okay? So that's what value bars are doing. MQ momentum is showing us the momentum of a market. It's similar, set up similar to how an MACD is, where you have your fast and your slow indicator lines, and then you have the histogram that's showing the spread between the two. What we're looking at when we're looking for divergences is the difference between your first group of histogram lines or histogram bars and then the second group of histogram bars. So here's high number 1, and that corresponds to this high here in the market. So there's high number 1 there. This is a bearish divergence. Here's high number 2, and that corresponds to high number 2 here. So 2 and 2. Where the red arrows are is the bearish divergence because we have just about equally high prices. You can see there's our high coming across. We're within just a couple ticks. We have a lower high indicator, so you have a sell signal. So you're getting short at overvalued up here. Your stop's going beyond the high. Your exit is as soon as you hit undervalued. So right there is your exit. Okay, so you're trading from basically 96.30, and then 6 minutes later you're out at undervalued at 96.25, 96.20 in this area right here. So you're out with 7 to 10 ticks in profit. Not bad for a 6-minute trade. Remember, you're just value range trading and you're just scalping. The next opportunity we have is a bullish divergence on this 2-minute chart. So here's low number 1 corresponding to low number 1 here. That is our first low with our histogram and with our price. The second low is right here. You can see we have equally low lows. We're moderately undervalued as shown by this lower yellow bar segment. You look at our second low here on our histogram and on our indicator line, we have a higher low indicator and a higher low histogram. So higher low indicators, equally low or lower prices. Bullish divergence, moderately undervalued. So we're getting long from around 96.15. We're getting out as soon as we hit overvalued right here. So there's our overvalued profit target. So we're out at 96.25, 96.22 in between that area. So again, 7 to 10 ticks in profit. Now you could potentially have caught this bigger move, but remember, when you're value range trading, you're getting out at the opposing value level for a reason. Your goal when scalping is a scalping profit target. So you're sticking to the strategy. You can't expect, unless you're intentionally trying to catch a bigger move by drilling down, then your goal is what your strategy's goal is, okay? So you're not going to say, well, actually, I'm going to go ahead and hold it longer, unless your goal for getting in it was for a longer trade. The next opportunity we have is a bearish divergence where this red arrow is right here and right here. Bearish divergence, here's high number 1, okay? And that corresponds to this group of price bars there. Here's high number 2. That corresponds to this group of bars here. You also came up significantly overvalued at that upper top, the upper red bar segment. So you're getting short there, call it 96.52. You're covering as soon as you hit undervalued here at around 96.47. So again, about 5 ticks, 6 ticks in profit. Again, you're scalping. The market did move much further down. That's okay. You're scalping with this strategy. If you want to trade longer term moves, trade longer term divergences on a 5-minute chart or 10-minute or 15-minute chart. The next opportunity we have, here's low number 1 and here's low number 2, so bullish divergence. And you look at your indicator line, here's low number 1 and here's low number 2. Now you can see with this one, we didn't quite make it back up into upward momentum before coming to the downside momentum. That's okay for some of the divergences. It's a more conservative approach, meaning you're going to be getting in it. You'll have more signals than you otherwise would have had, but that's all right. If it looks, especially when it's like this, where it just barely doesn't quite make it to overvalued or to upside momentum, you're in good shape. So you're getting long there. Again, you're long from undervalued or significantly undervalued, where you had your equally low lows. So you're long from 96.41, 96.42. You're out as soon as you hit overvalued, and you're all the way up at 96.45, 96.47. So again, 4 or 5 ticks there. Now it does move further. That's okay. You can try to catch longer moves if that's what your goal is, but for tonight we're talking about scalping. We're talking about value range trading. Again, if you want to have a longer, or have the market move more in order to reach your value target, then you can adjust it and use a longer analysis period. And I'll show you some examples of that here in just a moment. Now we're taking a look at crude on a 5-bar analysis period. So we have our first high number 1 there, corresponds to high number 1 here. And this is during that grinder. You can see right here, this is from about midnight until 2 a.m. You can see where I'm talking about the grinder, where the market's just kind of choppy. You can still trade it. You use a shorter analysis period compared to where I said around 8 a.m. or 7 a.m. in that area until about 2 p.m. You can see much bigger moves occur. So high number 1, and that is corresponding to that upper price, the price movement there, and the histogram there, and then high number 2 is right here. You come up and overvalued. Now you never hit undervalued with this trade. You were still in the money by a few ticks. So depending on how conservative you wanted to be with your stop placement, you could have potentially had a break-even stop in place there. I will typically put a stop at break-even as soon as I go through that blue line. That blue line is an 8 exponential moving average. Now this is why it is important to be entering on the proper side of value and having good fills, because you want to have a couple ticks when you're getting in that can really affect a good trade, make a good trade be a bad trade, or make a profitable trade be a not profitable trade. Because if you're getting in late, then you're missing half the move, especially if you're scalping. So again, the next opportunity we have is right here, where we came back up moderately overvalued. So here's high number 1, corresponding to high number 1 here. Here's high number 2. We didn't quite make it back up to the equally high highs. We were close. We were within about 5 ticks. We were moderately overvalued according to value bars, though, so we had the okay to go short because we had significantly lower momentum, and even the downside momentum was increasing. So again, that has you short around 96.10, and then you're covering right around 96, so you're taking about 10 ticks out to the downside there. The next opportunity we have on this 5-minute chart is a bullish divergence here. Okay, so this is low number 1, and that corresponds to low number 1 here. Here's low number 2. You actually have lower low prices, so that's even better. When you have a divergence where you have lower low or higher high prices compared to the previous low or high, and then your indicator is still higher or lower in the opposing direction, that's even better. So you have low number 1 here, low number 2, corresponding to low number 1 here, and then low number 2 much higher than the previous low. So you're getting long at moderately undervalued, call it 95.75, and then you're getting out as soon as you hit overvalued at 95.90. So again, you're on 5-minute charts, so you're catching a little bit bigger move. You're catching about 15 ticks that time because you're in undervalued and out overvalued. Now remember, you can catch larger moves, but if you're trading the divergences, your goal isn't for the larger moves. Your goal is to be scalping if you're trading these short-term intraday divergences like this, which is what this webinar is on, scalping. So we're having value range trading in and out between the value ranges. The last opportunity on this chart is a bearish divergence. There's high number 1 corresponding to high number 1 here, and then here's high number 2. You have higher high prices. You also had a value candlestick reversal pattern there, and that corresponds to high number 2 here. So you're significantly lower there, significantly higher here. You have a short up here. You're short around 96.70. You hit undervalued all the way down here at 96.50. So you caught about 20 tick move from overvalued to undervalued there off the bearish divergence. Not a bad trade in my opinion. Again, during the day, during the prime trading hours, you're going to have much larger price moves than you would if you were trading during the grinder, which is the after-hour trades. Now let's take a look using an 11-bar analysis period. So we extended the analysis period on our value bars to be a little bit longer, which makes it a little harder for the market to hit each value level. That takes a little bit longer. So we have our first trading opportunity here. Here's low number 1, all those down bars right there, and that corresponds to this whole set of down bars right here. Here's low number 2 right here, where we had lower low prices with a higher low indicator histogram corresponding just like this between the two. You're moderately undervalued, so any of these undervalued price bars are a good entry. You're long from, call it 94.90. You're out at 95.02. So about 12 tick move off of a 10 or off of a 2-minute chart. And again, that trade lasted 2, 4, 6 minutes. So again, 6 minutes, you're taking 12 ticks out of the market. Not a bad trade. Your next opportunity, here's high number 1. It's all this group of price bars here. That's high number 1. Corresponds to this entire group of up bars there. So 1 and 1. And then high number 2, you come back up, you break the highs, you hit overvalued. That corresponds to this set of highs here, significantly lower than the previous high. With a higher high price, you're short from, call it 95.15, even if you got in late. This is where being picky with your entries with a limit order can really pay off. And this rolls over and sells off all the way down to, call it 95.07. So you made another 5, 6 ticks there, or even 10 ticks, depending on where your entry was. So very nice trade there as well. And again, with each of these trades, you're only risking 50, anywhere from 5 to 10 ticks, so $50 to $100 per contract. And you're taking out anywhere from 5 to 20 ticks. So you have anywhere from a 1-to-1 to 4-to-1 reward to risk ratio with the trades. Now let's take a look with an 11-bar analysis period on a 5-minute chart. After we look at this, then we'll roll over and look at TradeStation and pull up some examples from today and from past few days on a couple different time frames. Why would you be trading the longer analysis period? During the day, when the market is more choppy or more volatile, where you're having larger price swings, you can trade a longer analysis period. During the beginning of the day, when you're really in that grinder area, then you're trading a shorter analysis period because the price doesn't move quite as far. All right, so here's high number 1, corresponding to high number 1 here. Here's high number 2. We get all the way up, significantly overvalued. So you're having, okay, time to go short, significantly overvalued, higher high prices, significantly lower high indicator. So you have a bearish divergence there. That sells off. Now, if you got short in any of these significantly overvalued prices, it doesn't hit undervalued until way over here. You do hit your break-even point, though, because you're hitting this blue line, which is your 8 exponential moving average. So depending on where you got in, you might have gotten stopped out break-even. Either way, not a bad trade because it did. If you held it and you didn't move your stop to break-even, you were profitable. Even if you waited until you got even if you hit the 8 EMA and moved your stop to break even, then you're out break even, you didn't lose anything. This webinar is being recorded, yes. Here's the next opportunity. So here's high number 1, corresponding to high number 1 here. Here's high number 2. Now high number 2 here, equally high highs. We did not hit moderately overvalued. The reason we didn't hit overvalued is because we had the longer analysis period. But that corresponds to high number 2 here, which is significantly lower than the previous high. It did not even make it up into upside momentum. So lower high there, equally highs here. You have the okay to get short. That gets you short from, call it 96.30. That comes all the way down to 96.20 where you hit undervalued. So you're hitting your profit target. So nice trade there as well for a very short-term scalp. Now we can take a look at TradeStation, see a few examples from today and the past few days. Before we do that, very quickly, I want to answer as many questions as I can. One thing to keep in mind, if your question is not answered and you have some questions about the live trading room, about the indicators, anything like that, feel free to send an email in to support@microquant.com here at the bottom. How do you get both histogram bars on MQ momentum? What are the two histogram lines called on in MQ or value charts? I'm not sure what you're asking. When? Do I use limit orders? Yes. When trading the scalps like this, I do use limit orders. I'll put my limit just at the previous high or low. So for example here, there's my low. My limit would have been right there. So I would have been in it there. Might have gotten stopped out, would have gotten back in it. There's a couple different ways you can trade it where some are safer, some are a little bit more aggressive, some are more conservative, and we'll talk about all those in the Divergence workshop. Better ways to trade it potentially. What's the analysis period do we use on 2 and 5 minute charts? I personally like using a 5-bar analysis period for all of my trading. Now, that being said, adjusting it to 11 or 10 or even 21 bar analysis periods can be very beneficial in certain market conditions. I personally don't change it to that with my own trading, but I know many traders that do that are very successful doing that, using longer analysis periods. Why are we using longer analysis periods in this case? Depends on the time of day. Again, it also depends on if you want your profit target to be reached much sooner. The longer your analysis period, the longer it's going to take for your profit target to be hit, for it to shift from undervalued all the way up to overvalued. If you're using a 5-bar analysis period, it'll get from under to overvalued very quickly. Why didn't the series of red overvalued price bars trigger a bearish divergence earlier? Are you talking about this right here? Because that's not a bearish divergence. Your momentum is heading higher, which means the market has a lot of strength moving to the upside. You have to keep in mind, value charts are not designed to be traded, okay, as soon as it hits overvalued, you sell. As soon as it hits undervalued, you buy. They're designed to help you filter out your entries so you can have a more strategic entry point where you have a higher probability of the market moving your direction sooner. So you have to take it into consideration with the overall outlook. I would not be looking to short here when I see this momentum increasing like that to the upside. That's very bullish to me. That's saying, okay, there's a lot of strength to the upside. That market could continue to go on. I don't care if it's overvalued. You want to see overvalued prices hit when the market's going higher, and you want to see undervalued prices hit when the market's going lower, because that shows the strength. So if in an uptrending market, you expect to see and want to see those overvalued prices, because it means the market has a lot of strength to the upside. Just like in a downtrending market, you expect to see and want to see undervalued prices because it has a lot of strength to the downside. No, you do not have to have MQ momentum with value charts, otherwise it's a one-leg horse. No, you can use other indicators like a MACD or a stochastic oscillator. You can use other indicators to judge the outlook of the market. You don't have to have the MQ indicators. I personally like using MQ momentum more than anything else. It's one of the best divergence indicators I've ever used. All right, I'll answer the rest of the questions after we take a look at some live examples very quickly. So pull up TradeStation and see what the markets look like right now. Okay, we're back. I want to make sure everyone can see my screen. You can see the chart. You can see here we're in that grinder period where I said the markets don't really move very much. But take a look. You had bearish divergence right here. This is actually what that last one was, that last example I showed you where I said it sold off. I took this picture, a snapshot of this market right before we did this webinar earlier today when this market was right here like this. That was using an 11-bar analysis period. So if you pull up your value bars and we adjust this, this is on a 7-bar. We pull it to 11, you see that actually never hits overvalued. That's in fair value. Whereas if you change it to the 5-bar analysis period, it does get overvalued for the short opportunities. So it helps to have the 5-bar analysis period sometimes. It also helps to have the 11-bar analysis period other times. Really just depends. But again, here's a bearish divergence because we had equally high prices, moderately overvalued, significantly lower high indicator, and this sold off very nicely from 96.32 and then hit undervalued at 96.22. So again, a 10-tick move, you were risking about 4 to 5 ticks, so you had a 2-to-1 reward to risk ratio. Again, even here, bearish divergence here. here's your high number 1. That group of bars there, that corresponds to this group of bars here. So there's upsurge number 1. Here's upsurge number 2, where you hit significantly overvalued. And that corresponds to this one here. So you have a lower high on your indicator, a higher high on your price. You have the okay to get short. And even getting short there, you're getting short around, as soon as you hit significantly overvalued, that's at 96.26. If you waited until the momentum actually rolled over, which was on this bar, then you were getting short around 96.30. That still sold off all the way to 96.10, so 20 ticks when it broke through that 8 EMA. It did end up rallying back up and forming another bearish divergence though. So the second bearish divergence was from this high here. Let me get rid of these. It was from high number 1, where the red arrow is, and high number 2 is where the blue arrow is. Not quite equally high highs, but you did hit moderately overvalued with a significantly lower high on your indicator line and on your histogram for a short. That gets you short right around 96.30, and you're covering at 96.25 or significantly undervalued 96.16, depending on how long you held that. We can also go back and we'll look at some that occurred any time in the past. Here's a great example right here of a bearish divergence on a 5-minute chart in crude oil. Here's high number 1, and that corresponds, remember, to high number 1 down here. And then here's high number 2. Just about equally high highs, moderately overvalued, significantly lower high indicator for a short. So you're moderately overvalued, equally high highs, and that sold off very nicely. You were in it short from around 93.26. It came all the way down undervalued at 93.03. So again, almost a 23 tick move. Very nice trade there. So again, these occur, the divergences occur all day long in a lot of different markets in a lot of different time frames. So there's high number 1 on the bottom and high number 2. So high number 1, high number 2, significantly overvalued, lower high indicator. That sells off from significantly overvalued at 93.03 all the way down to undervalued at 92.90, call it, so 13 ticks. Nice moves to the downside there. And you can catch bigger moves. You just have to keep in mind what you're trying to trade, whether you're trying to trade a longer term trade or if you're just scalping like we're talking about here in tonight's webinar. So now we'll take a look. That's some 5-minute examples. We'll take a quick look at a few different 2-minute charts so you can see some 2-minute examples as well, and then we'll look at 1-minute charts. This is when it gets really choppy here. This is what I call the grinder, where the market's just jumping up and down. It's harder to trade this, much harder to trade this, and I would never trade it without using limit orders. I typically won't even trade during the grinder period like this because it's so choppy. There's not enough volume there. But you go back here and let's look for potential bullish and bearish divergences. So here's a potential bullish divergence. There's your low, low number 2, equally low lows with the previous low. You're up a tick. You're getting long from 96.15. You're out as soon as you hit overvalued at 96.24, 96.25. So you're out plus 10 ticks, and that trade lasted 4 minutes. Very nice trade there. Equally low prices, higher low indicator. The next opportunity we can look for. Here's a bearish divergence right there. Right here, significantly overvalued, lower high indicator compared to the previous high, and that even sells off from significantly overvalued at 96.04 all the way down to undervalued at 95.91, so 13 ticks there. Again, nice trade. It lasted about 10 minutes long. You're just scalping it. So you're trying to get in and out very quickly, and you're actually risking as small of an amount as possible. You also had a very nice bearish divergence right here, where you had, here's your first high, significantly overvalued, your second high, moderately overvalued. You broke the previous highs, you're in it from around 95.94. It sells off all the way down to 95.80, so 14 ticks, call it. You hit that 8 EMA, it never hit undervalued, which is fine. You would have been out break even. And actually, I was trading this earlier today with a friend of mine, and we actually were short here and we were short up here for both of those divergences for potential short opportunities. We were trying to catch a longer term trade though, so we kept getting stopped out break even. Now, again, the divergences occur all the time throughout the day. You just have to be sitting there watching them, and once you get used to identifying them, they're very easy to spot. So here's your high number 1, and that's corresponding to this high here. This is actually a double bearish divergence. So here's your first high, and that's this high here. Here's your second high. Higher high prices, moderately overvalued, lower high indicator. That sells off from 95.57 all the way down to undervalued at 95.53. So you have 4 ticks, or if you waited until significantly undervalued, you had 10 ticks. Your second opportunity is the double bearish divergence. Again, equally high prices, lower high indicator, and that sells off from 95.58 all the way down to undervalued at 95.47. So another 11 ticks there. Another great trade. Again, it's only taking 2 to 4 minutes for these trades to occur. Now, we can also look at using a longer analysis period. So let's change this, say, to a 14-bar analysis period, which is the default setting. You can see here the second high didn't even get into overvalued. So you had a value divergence as well as a momentum divergence, where you had a higher price or an equally high price with a lower value level, where the previous one was moderately overvalued. This one is only fair value, so never couldn't even get up into moderately overvalued. You also had the divergence on your MQ momentum, and then it still sold off, and that gets you out a little bit lower than previously, about 1 tick lower. And you can come back and look at the other trades we were talking about as well. You'll see where you were only getting a couple ticks at a time there. This one, instead of only taking 10 ticks out, you're in it from 96.03. You're out all the way down at 95.83. So you actually took 20 ticks out. You can see it took a much longer amount of time before you hit undervalued, which is your profit target if you're range trading. And here I'll change it to a 5-bar analysis so you can see the difference. Here's the level that it hits undervalued using a 5-bar analysis period, so much sooner. I'll change it to a 11 or a 14-bar analysis period. And you can see it doesn't hit undervalued until all the way down here. So there's that much of a difference. There's a 10-tick difference between the two if you're using a longer analysis period versus a shorter analysis period. Remember, if you're using a longer analysis period, you're not going to have undervalued prices right here like we did before, because it has to move a much further distance to get to each value level. So the 5-bar analysis period is going to be a lot more reactive. You'll have more trade signals, but you'll be in and out much sooner than if you're using a longer analysis period. So we can go through and we'll take a look very quickly at some questions, answer some questions, and then we can also look at different time frames. If you have a specific time frame you'd like to look up, let me know. We can look up any time frame. The divergences occur anywhere from 1-minute charts all the way out to daily or weekly. Is the webinar going to be recorded? Yes, the webinar is being recorded. Can you use this strategy for other instruments? Absolutely. Divergences occur in all the markets that you trade on all different time frames. You can trade divergences all the time. We trade them very often in the live trading room on many different markets and many different time frames. If you want to learn a lot more detail, you want to get into a lot more detail on how you actually trade a divergence, when you get into that divergence, where your stop goes when you get in, when you get out, how to manage it, how to catch bigger moves on a smaller time frame, how to risk the same amount that you would on a 1-minute chart and catch a move that you would on a 30 or 60 or daily chart. We're going to cover all that in the Divergence workshop. We try to keep these free workshops or free webinars around an hour long. So we try to cover as much information as possible and still make it so you can understand it, but we don't get into a lot of detail on actually trade management. So if you do want to learn more about that, come to the Divergence workshop, which is in April. The price is increasing on Thursday, so you have a day and a half before the price increases. Right now it's at half price for the early bird special. What MACD values do I use? Here, I'll insert an MACD really quick so you can see what it looks like with an MACD. Like I said, you don't have to use MQ momentum. MQ momentum, in my opinion, does a much better job of identifying divergences compared to a MACD, but you can still find bullish and bearish divergences on the MACD. For example, you had a bullish divergence here where you had just about equally low prices, significantly higher low indicator. So you have a long signal. As you can see, the MQ momentum much more reactive to the market than the MACD is. So you're going to have more signals. But see here, you had actually a very nice short signal on the MACD on the 2-minute chart up here at the top where you didn't have that on the MQ momentum. So you can see lower highs on your indicator lines and on your histogram compared to the previous high with higher high prices. So you can still use the MACD the same way. I prefer MQ momentum, more reactive, and like I said, it's one of the best divergence indicators I've ever used. I just enjoy it. Does this work for the S&P, E-mini futures, and gold futures? Absolutely. You can trade divergences in gold and the S&P all day long. How do you add an 8 exponential moving average to the chart? Right-click on the chart, insert analysis technique, go moving average, exponential. Right there, you just add it. Do I look at trend lines and or support or resistance on larger time frames, or not necessary with the scalping? With the scalping, it's not necessary because you're only catching these smaller moves. You're not looking to catch larger moves. That being said, I always have support and resistance and trend lines drawn on all my charts. If you're in the live trading room, you see that I have it drawn all over the place for potential support and resistance levels because it's a good thing to be aware of so you can get a longer term outlook. Okay, it's forming a bullish divergence here. It also has a longer term bullish divergence as well as a trend line that's sitting right on. So I'm going to get long, and instead of getting out at overvalued for the value range trade, I'll try to hold it for a longer term analysis or for a longer term swing trade. Do the indicators work on NinjaTrader and TradeStation? Yes, the indicators are all available on NinjaTrader, TradeStation, Multicharts, Bloomberg. We're coding for eSignal and TOS right now, and a couple other platforms as well. Are the suggested analysis periods for different periods, volatility conditions available on the website? No, that's a good idea though. Send me an email, Ronald, and I will try to get you a list of analysis periods. What I would say is you change your analysis period based on the choppiness of the market. When the market's really smoothly trending, you can use a 5-bar analysis period. When it's more choppy like it is back here, where we have price swings up and down, look at if you change your analysis period to a 10-bar analysis period. You can see it does a much better job of identifying highs and lows than if you're using a 5-bar analysis period. So the choppy markets, the choppier a market is, the longer the analysis period you can use. The smoother the market's trending, the shorter the analysis period you can use. Do I always enter a trade at moderately over and undervalued and not significantly over and undervalued? It depends on the trade. Sometimes I will do significantly, sometimes I will only do moderately. It just depends on the overall context of what the market's doing. Should the MACD, MQ momentum, I don't change the settings on MQ momentum. I just use default settings on that. Now, you can use a smoothed out indicator line. For example, you can use 32 and maybe change it to a 10 smoothing. That makes it a little bit less reactive, a little less choppy. You can toy with the settings like that. I know some traders that like using longer smoothed out momentum or MQ momentum lines, maybe a 50, 25, and 7. You can see it gets a lot smoother for judging the momentum, which that is also very helpful for catching divergences sometimes, but also for catching longer moves. So if you're looking to stay in a market while there's upside momentum, you have a longer smoothed out momentum line. You can see you're holding that long this entire up move until it switches back to downside momentum. So smoothing out your momentum can help you catch bigger moves if you're trying to do that. Show some gold divergences. Absolutely. We'll pull up gold really quick. This is supposed to be a crude oil divergence webinar, but I'll show a few divergences in gold. I'll look at it on a 5-minute chart. Again, you're in the grinder, so it's kind of choppy. But let's take a look at some divergences in gold on this 5-minute basis. You can go back, you can see a couple divergences here where you have just about equally high prices and a lower high indicator. You can also judge it off of the indicator line itself, where you have equally high prices coming across right here, moderately overvalued, significantly lower high indicator line, although your histogram is slightly higher. It depends on how you want to trade it, but this is showing weakening momentum this entire time, and then it spikes up into overvalued. Great bullish divergence right here. Here's low number 1, low number 2. Here's your histogram, low number 1, and then low number 2 for a nice bullish divergence, moderately undervalued. You also have a golden doji reversal pattern, one of the candlestick patterns. That gets you long from 1597.30. You hit overvalued at 1599.20. So almost $2 an ounce move there. Very nice. But yeah, you can trade, but like I said, the divergences occur in just about every single market I've ever traded. I've never seen it where there's not divergences. So you just have to be watching it. But you can find some great trade opportunities off of divergences all day long. Very excited about the upcoming Divergence seminar. Glad to hear it. Look forward to seeing you in it. Can you use microcurrency futures? You can trade it on currency futures. Absolutely. Yes, I look at the histogram more than I do the indicator lines. A lot of traders like using the indicator lines instead. That's completely fine. I like using the histogram personally. But while I'm saying that, here's another divergence, a bullish divergence. There's low number 1, low number 2, or even again over here. Either of those dips right there would have been bullish divergences as well. And then low number 1, low number 2, significantly higher low indicator, lower low prices. It rallied up very nicely from any of those entry points for longs. You would have been long from around 1605.50. You get out 1608.50. So that $3 an ounce move there. Do I trade 30 and 60-minute charts? What analysis period would I use for them? I absolutely trade 30 and 60-minute charts. If you're in the live trading room, this is the screen that you see all day long. My 30, my 60, my daily, and this is actually a 15-minute chart typically up there. And I'll trade divergences on all of those. I mean, you can see here in gold, you had a great bullish divergence right here. Equally low prices right here, significantly higher low indicator, and that rallied up from 1596 to 1601. So just about 1602. So you can trade it on longer time periods as well as shorter time periods. The divergence alerts us to the trade opportunity, and value bars define the entry and exit points. Correct. Good way of phrasing it, Henry. The Divergence workshop be recorded? Yes, it will be recorded, and anyone that has purchased it will receive a recording as soon as we have it ready. For those of you that were in the last workshop, we're still trying to get that recording available. As soon as it's done, we're going to be sending it to you. I know a couple people have been asking about that. Do I use the default settings on MACD? Yes. Does it work in the grains markets? Yes, it does. Here's a great bearish divergence in soy on a 15-minute chart. Here's high number 1, high number 2, moderately overvalued, significantly lower high indicator. Sold off very nicely from 14.49 all the way down. Undervalued was 14.45 3/4. All the time in the grains. I mean, here's a bullish divergence here. Equally low prices, actually lower low prices. You had a tick below it, higher low indicator for long opportunity. How will the strategy work on bonds? It works pretty well in bonds. One thing I'd say about bonds, though, it's harder to trade. You can't really trade divergences in bonds on 1 and 2 minute charts. Sometimes on 5-minute charts you can. That's a little bit more difficult because bonds on a 1 minute and 2 minute chart, they're kind of choppy, but a 5 minute chart, you can identify some nice trades. Longer time frames like this 15-minute chart here, had a great bearish divergence on the 15-minute chart here. So longer time frames, absolutely. Shorter time frames, it's a little bit harder. Is crude oil a good overnight short? I cannot tell you that. I have no idea. I'm bullish crude oil longer term. We've been talking about crude oil, being bullish crude oil for a while now due to a trendline retest here on a weekly chart. So I'm expecting crude to go a little bit higher. I would say though that crude's overvalued on a few different time frames. Do I enter intrabar or wait for the bar to finish? There's different ways you can do that. I'll enter intrabar sometimes. I'll also wait for the bar to finish sometimes, and we'll talk about that in more detail in the Divergence workshop. Can't go into detail on everything. We'd be here all night long. That's why we have the workshop. Are the 2 sessions for the workshop 2 or 3 hours each? Honestly, it's going to end up being around 3. The reason is because I don't end the workshop, or I don't end the trading day for the workshop or the classroom session for the workshop until I've answered all the questions. Because if you paid for it, I want to make sure you understand the ins and outs of it so you can go and trade it on your own. We charge what we do because that's what we feel like it's worth. You can make it all back in one trade. It should pay for itself very soon. So it could end up being 4 hours long. Like I said, I'm not going to close it until everybody's questions are answered, until everybody understands how it works, how the strategies work. Any free trial? We don't have a free trial of the indicators. If you send me an email, I'll give you a free trial to the live trading room, or send an email to support@microquant.com. They'll give you access to the trading room for a day. You can come in and see how we trade, or you can sign up for the newsletter and just receive free access whenever we have an open house, which is every other Wednesday. But if you want to get in, for example, tomorrow or the day after, send an email to support@microquant.com. Just asking for the link to join the live trading room, and they'll send you one for free for a day. Does the histogram highs and lows have to line up with the price bar highs and lows to be a real divergence? The histogram highs and lows, I'm not sure what you mean. Do they have to line up? You want to see a divergence, meaning you want to see them different. You want to see higher prices and lower histogram, or lower prices and higher histogram. So you don't really want them lined up. Would the trading room cater to those who trade 3 and 5 minute time frames? Yes, we do a lot of scalping. We also do swing trading and day trading. What we'll do in the trading room, the way that we'll do it, we're looking at all the time frames at once, and then we'll say, okay, our overall direction that we believe this is going to be going is this way, and then we'll drill down and look at an intraday time frame on a 5 minute chart or a 1 minute chart or a 2 minute chart to time our entries. What analysis period do I use on the 30s and 60s? I typically use a 5-bar analysis period on all of my charts. Can value charts be automated to alert when a divergence happens? No. When's the Divergence workshop? It's the 2nd week in April. You can go to, when is the Divergence workshop? April 11th and the 12th. From 5 until whenever we finish answering questions and everybody understands how it works. And then the following week, you also get access to the trading room for that entire week from 8 a.m. until 12 noon, which is the hours of the trading room every day. So you not only get the workshop where we go into detail and teach you how you trade the strategies, you also get to come into the trading room and actually see us trading the strategies. Again, if you want to read more about what's going to be covered in here, we have a whole list of everything that's going to be talked about. All you have to do is go to valuecharts.com. You click on this left-hand side where it says Live Online Workshops, the Divergence Workshop, Divergence Trading. You can click on Learn More, and there's going to be a whole list of things you can read about what's going to happen in that workshop, what we'll be talking about. Link for the workshop. Here, give me a minute. I'll send you a link actually via chat. There you go. I believe everybody should have that link. That's the link to learn more about the workshop, the Divergence workshop. What's the workshop cost? Right now it's $4.99. The full price is $9.99. It goes up. The early bird price increases on the 28th, so in 2 days. What analysis period do I look at in crude oil to say it's overvalued on many time frames? Like I said, I personally use a 5-bar analysis period on everything because I like having much more reactive price bars. You would not be able to come to the live trading room the following week. Can we adjust it so give you access to the trading room for a week later on in that month or the month after? Yes, if you come to the workshop and you're not able to make it to the trading room on that following week, but you paid for the workshop, we'll make sure you get a week of access. We can arrange to have you receive links for a week of your choosing. Is it good until midnight, March 28th? I believe it increases on the 28th, so I believe it's good until midnight tomorrow, the 27th. Will the recording be online right away? We'll try to get the recording up as fast as we can. I spoke on group training. Not sure what you mean, Elizabeth. Which gives a dominant signal, the indicator lines or the histogram? The histogram, in my opinion, gives the better signal. When you have them both in agreement, meaning they're both a divergence, so you have lower highs on the histogram and lower highs on the indicator line, that's an even better signal. You know what's interesting is today we were trading crude oil in the trading room today, and we were looking at a trend line coming up and across, and we actually talked about longs right at the close of the trading room. We had shorts up here off the bearish divergence today in the trading room. That worked out very nice, and then we covered and we talked about going long here. I'm not sure if anybody actually ended up taking the longs, but those ended up being very nice trades. It rallied up quite a bit more than I thought. It was forming a bearish divergence, but it quickly broke through and did not form a divergence. So that would have been a great trade for anyone that took those longs. Do I have a copper signal now? Let's take a look at copper, and I'll tell you what I think copper is doing. It's starting to form a bullish divergence. What I would say, though, you'd want to see equally low prices. We had shorts in the trading room earlier today from those highs, basically. That has ended up being great trades. Nice job for those of you that are still holding on to that. I know a few people in the trading room were holding it longer term for a swing trade. That was a great short. Worked out very nice. Oh, Elizabeth, that will release more information on that in the future. We don't have that completely set up yet. Once we do, it's going to be a lot different, a lot different than the workshop. Ronald, I believe it's going to be on both a DVD and a downloadable recording. Does the MQ cycle finder add to the divergence? Yes, it does. So if you have a divergence on both your momentum histogram and the cycle finder, it's a better divergence in my opinion. So yes, you can use a cycle finder as well. All right, seems like there's not very many more questions coming in. What's the pip in crude worth? One tick in crude is worth $10 a contract. So when I say 7 to 10 ticks, you're making $70 to $100 a contract. So that's going to be it for today's webinar. I hope you enjoyed it. Again, if we didn't answer your question or you have any more questions, send your email into support@microquant.com. and we'll be more than happy to answer that. If you want to come into the trading room for try it out for a day, send an email on to support@microquant. We'll give you access for a day. You can also sign up for the free newsletter at valuecharts.com. Remember, the price of the Divergence Workshop is increasing. If you want to get into it, I would do it tomorrow because it's going up the next day. So hope you enjoyed it. Robert, not yet. We're working on that for Signal Feed and Trading Room. I'm not sure about Signal Feed and Workshop though. Hope you enjoyed it. Again, that's going to be it for today. Look forward to seeing everyone, or many of you, in the trading room tomorrow, bright and early. And I'm going to go ahead and end the webinar for today.